And welcome to ETF Edge. This is your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. An historic day for the markets and for the ETF business. S&P down almost 7% after opening on continuing concerns about the economic impact of coronavirus. But was thrown an additional whammy when Saudi Arabia and Russia failed to agree on an oil production cut, and the Saudis responded by slashing prices all on their own, sending oil stocks and oil into an even deeper tailspin. S&P was halted down 7% for 15 minutes after 9:33 a.m. Eastern Time, then reopened 15 minutes later. Here to break down that historic day, this historic day, Dave Nadig, Director of ETF Database and ETF Trends, Jeff Kilburg of KKM Financial, and Samara Cohen, co-head of iShares Markets and Investments. Dave, has the ETF structure held up during this volatile period, and what should investors be watching?
Yeah, absolutely. This has actually been a great victory for ETFs as a structure. Everybody's been concerned, sort of in the mainstream media, that a big volatility spike like this would unravel some part of the market we didn't understand. In fact, the opposite has happened. ETFs have delivered like champs here. We've had no major breaks. Even with the circuit breaker hit today, the reopen off that circuit breaker was frankly flawless.
Yeah, Samara, what about that? One area investors are particularly interested in is the high yield market. The high yield under particular pressure because of exposure to energy stocks recently with significant debt. You run the iShares high yield ETF, that's HYG. Can you describe how the trading has been on that, not just today, but in the last couple of weeks?
Yeah, absolutely. The story that Dave just told on ETFs broadly is absolutely true for HYG as well. So last week was actually mostly about rates. 2 weeks ago, the story was about high yield, where HYG saw significant redemptions, $3.4 billion. But to Dave's points, those redemptions were orderly. They were broad-based with a variety of market makers, liquidity providers, and authorized participants participating. And importantly, those redemptions were a fraction of the $40 million secondary volume that was happening on exchange.
So what happened to this idea that the ETF haters have been telling us for years now, oh, wait till there's serious volatility because some of these thinly traded securities underneath these, for example, some high yield, they're not going to be able to trade and to freeze up. The ETFs are going to freeze up themselves. But so far, this hasn't happened. Now, is this because you can trade the ETF without trading the underlyings necessarily? I mean, why is it held up so well? We should be happy about this, but they're doing explanation. All the ETF haters, why are they wrong?
I think that's exactly right. I think what we're seeing in this, high velocity market, as in past fixed income stressed markets, the bond market is better with fixed income ETFs in it than it was without. Fixed income ETFs provide support to the bond market. It's a place for investors to exchange risk. And to your point, the bulk of that risk is happening. It was balanced trading across buyers and sellers on exchange with that $40 billion of secondary volume. And that's very supportive to a high velocity market.
I think it's also worth pointing out that despite the hiccups we've seen in the last week, we've had net inflows into ETFs. Yeah. Last week was a positive week for ETFs, pretty much across the board except for international equities. Now we'll see what happens in today's flows, but the reality is investors are using ETFs as their core tool for expressing opinions in this market.
I think it's a tremendous development. Jeff, I want to bring you in here. So there are other ETFs with significant exposure to energy debt. Some of these are so-called fallen angel ETFs. They have the highest exposure to some of the energy debt, around 20%. Some of the other ones, I think HYG, JNK, maybe just 10% exposure on the energy front here. Your thought on these right now?
Well, Bob, it's really interesting. We are seeing FALN hold up fairly well. And if you look at last year, it had a gangbuster year, up about 17%. So certainly it's seeing distress today, but by and large, people who are willing to take that risk appetite of that fallen investment grade corporate bonds, this is part of the puzzle. You're looking at TLT, up 25% year to date. But if you look at the pure play XOP, Bob, they're seeing distress, down about 23% today. I think it's an overreaction, but nonetheless, these ETFs, they're doing exactly what they're designed to do.
I just want to, for those of us who don't know what fallen angel, like FALN, for example, these used to be investment grade debt.
Right.
It has fallen into high yield or junk debt. And the theory behind this, explain this, Dave.
Well, and we're going to see more of this too. So generally it's triple Bs that get downgraded. Usually what happens then is all the people who have to hold investment grade debt by mandate have to sell those bonds. They're not allowed to own them anymore. That puts over pressure on the sell side. That means they tend to get a little cheap versus the actual risk.
So actually this was created as a buying opportunity to say, hey, pay attention to the guys who are sold off most because there might be value
here. Exactly.
And we haven't seen that yet.
We're going to see some of these triple triple B names get downgraded. It's pretty much inevitable.
And there's some nice diversification in this ETF, Bob. You look at, Deutsche Bank, there's a lot of names that have fallen from grace, hence the name, FALN. But nonetheless, it is a broad diversification if you want this to be additive to your portfolio, because I think people will continue to search for yield.
Yeah, tough one here. Now, most of these energy ETFs already have very little investment. I mean, you look at some of the numbers here. What are the XLE, the biggest energy ETF, was $8 billion. And most all the other energy ETFs, they're below $1 billion, and some of them are just, below, well below 100 million. So any thoughts here on energy ETFs? People have been asking me how to play it. I said there's just not much there
well,
to
certainly
play.
When you're looking at these large cap stocks, the average large cap stock is only owned a few percent by the ETF market in general. So people look at the ETF because it's convenient, but it's not what's moving the market. What's moving the market is the opinion of people who are big holders of these names. That's the thing that's moving the market.
And where are assets going, Bob? They're going out of those ETFs, which are really specific to the oil patch. They're going to TLT. You're seeing a lot of movement into treasuries, and that's okay. AGG, another bond proxy that we're utilizing. So you're seeing a lot of those names attract assets short term to mitigate some risk.
Yeah. Samara, I want to turn to you again. There's been a lot of debate about whether these ETFs would hold up in this environment. We just talked about this. Now, this morning, the S&P futures traded limit down, and everybody was concerned about this. Yet the underlying ETFs continue to trade, like the IVV, which iShares you run here. It opened at 4 a.m. along with the other ETFs, provided very good indications, in fact, about where the overall market would open, and down between 6 and 7%. We've seen this often. ETFs provide reasonably accurate pricing, even when the underlying stocks are closed. And we saw this again today. We saw it with the Chinese stocks when the Chinese stock market, MCHI, which you guys run, provided perfectly good pricing indications, even with the underlying not available. Can you simply address that? People need to be reminded about this fact.
Yep, you're absolutely right. This morning, we were able to see where S&P ETFs were trading, IVB, SPY. We were also able to see where European listed ETFs were trading that referenced U.S. markets, and that gave us a pretty good indication going into the U.S. Open that we were likely to see a market-wide circuit breaker. And to your point, this was really the first test of that that.
And what magic happens here? People ask me, well, what magic happens? Like the S&P futures were closed. Well, they weren't closed. They were halted this morning, and yet there was still pricing provided. It's just the magic of the marketplace, kind of accurately figuring out. Is that a fair way to describe?
ETFs have become the dominant price discovery vehicle for illiquid securities. You talked about Halliburton when it closed earlier today. None of the ETFs that own Halliburton were closed. So you could look at any of those ETFs that hold large Halliburton positions, and you could get a proxy idea of where it was going to reopen, and it's been spot on all day.
All right, let me move on here. This idea that certain sectors with lower liquidity, high yield, or bank loads would blow up under stress hasn't happened yet. Dave, is this because these ETFs can trade without trading the underlying stocks?
Yeah,
that's the key here, right?
That's the key, right? So, generally it's something like 1 to 10. For every $10 that trade, here on the floor, there's $1 that may hit those underlying securities. Now, that goes up a little bit in times like this, but not much.
Is that a correct number? We don't need to trade all of the underlying stocks every day. Most of the time, the ETFs trade without the underlying stocks having to create or redeem.
That's exactly right. Usually, in this past week, it was about 1 to 10.
Okay. So is there a way to protect yourself against these kinds of black swan events that we're seeing right now using ETFs? Maybe. Well, let's bring in Kristen Magoon from Amplify. Kristen, you have a black swan ETF designed exactly for this. The symbol is SWAN. Could you briefly and simply tell us what it does and how would it provide protection against something like a coronavirus outbreak?
Yeah, hi, Bob. So really the theory behind Black Swan is to own S&P exposure, but to also own U.S. Treasuries. During times of market crisis, Treasuries are bought up like crazy, and they act as a great negative correlated asset to equity exposure. So the fund actually has about 65% exposure to U.S. Treasuries, about 35% exposure to the returns of the S&P 500. Last year, the fund returned 21%, 22% in a nice upward moving market. This year, the funds had about a little over 5% return coming into today, 12% ahead of the S&P 500 year to date. And we're seeing positive moves today.
We could clearly see the SWAN, which is the white line here, outperforming the S&P 500 in the last several weeks as coronavirus has hit. But how often do you say rebalance? You're obviously holding stocks and bonds. How often would you move more into stocks and less into bonds? How often does that rebalancing actually happen?
So it happens twice a year. It happens in December and June, and that rebalance really resets the portfolio allocation. But in general, the exposure is fairly constant to about a 65% exposure to U.S. Treasuries and about a 35% exposure to the S&P 500. This works a lot like a traditional balanced portfolio, but really shines during times in market crisis.
This is exactly what it is. It's a 60-40, or you have 65-35, but it's a 60-40 balanced portfolio essentially in a single ETF.
Yeah, and while this has done great, I think investors were looking for these kinds of safety plays, whether they're min-vol funds like USMV or Christian's fund here, Swan. There's others in the market, Tail, the Buffer series from Innovator. The important thing is you really have to understand the mechanics of how these things are going to work, because just in this year so far, we've seen a 30% dispersion of returns between the best performing and worst performing quote unquote tail risk
Because it depends on what you've got invested in and how often you'll rebalance.
Exactly, and whether or not you've got triggers, right? Some of the funds in this space trigger based on things like 200-day moving average. In fast moving markets like that, they may not trigger, so you've really got to be careful.
Samara, you've seen a lot of interest, of course, in minimum vol, and iShares has several of these products that were really big last year that basically just tries to figure out ways to tamp it down volatility. Minimum vol doesn't own bonds, but it's all part of the same idea.
In factors like minimum vol, like quality, companies with strong balance sheets. And also we're hearing a lot of conversations around just other sources of uncorrelated risk, like gold or like mortgages. In this environment, MBB and IAU.
Christian, do you always is it always going to stay roughly 65-35? In other words, if all of a sudden the actual weight's a little heavier at 75-25, do you rebalance down? Is it always the same target that you're having, or do you change it based on other criteria?
Yeah, it's a great question. It stays the same. It rebalances twice a year, but that target is the same. This is a fund that does work and hedge against black swan risks, but also something you can hold in an upward moving market. So it's really a core holding.
Okay, guys, going to have to leave it there. Terrific, amazing week, amazing couple of weeks. Thank you, guys. These are the experts in the business, folks. It doesn't get any better than this. You're seeing the brain trust for the ETF business right here in front of you. And that does it for this week's ETF Edge. I'm Bob Pisani. My thanks to Dave and Jeff and Samara and Christian for joining us today. And thank you for watching us. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.